Thanks for coming by. And today we're going to talk about the 200 EMA breakout strategy. Before I do, there's a link down below for those interested in options trading. We're going to talk about our two favorite markets, plus a unique one-day option strategy that you could trade. And the download is linked below. All right, so before we start talking about the strategy, let's just talk about consistency. It's probably one of the most prized traits of a trader. And that's what this trendline breakout strategy is designed to have: consistency, and to have you follow some basic rules. Because if you can't follow a simple trading strategy using very few variables, complex trading strategies are out of the question. Does simple work? Yeah, it does. You just have to be able to execute it. So for this strategy, we're going to use the 200 period EMA. And by using such a long period, we're looking at trading the longer term direction of the instrument. The 200, it's a little bit more forgiving than trading shorter periods like the 20 or the 50, and it lessens the amount of directional changes that you have to contend with. The other technical analysis tool we're going to talk about and use are Trendlines. There's arguments out there that only support and resistance that is horizontal matters. But let's consider outside bars. Prices will break horizontal levels and it's going to reject higher or it's going to reject lower. And the trend line, in my opinion, of course, I think it does a really great job of capturing the rhythm of price movement. And because outside bars are a reality, and if we discount trend lines, I think we're making a pretty big mistake. So what are the thoughts behind this particular strategy here? Well, we're only taking trades in the direction of the moving average. We're going to use trendline breakouts as a signal that price is going to continue in that direction, at least for the short time. And we're going to exit when price fails to follow through. So although the moving average, the 200, is generally used on the daily chart, I want you to experiment with this strategy on lower time frames as well. So after you applied the moving averages to your chart, I want you to note the price relationship to it. If price is trading above the 200 EMA, only consider long trades. Price is trading below it, we want to sell. And to avoid us getting chopped up, if price is just snaking around the average, whipping back and forth, either change your time frames or change the instrument. The first thing you got to do is define how you draw a trend line. An interesting technique, which I use quite often, is I connect the high and low of the swing and I drag the trend line to the outside of price. Right, this is an example. So when we construct this trend line, connect the swing high and the swing low. It's an obvious swing that we have here. We're going to clone the trend line. We're going to move it to the outside of the move, but we ensure that it does touch price. And over the years, I'll be honest, I've gotten away from the traditional drawings and I use this approach most often. So let's think about a buy setup. The red circle are the high and low of the swing. That line is then cloned or copied, and we put it on the outside of the candlesticks. The green candle is the buy candle. Now, there are a few ways to enter trades. We can buy when the day turns green. We can buy when that previous red candle, when that high is taken out. We could consider buy stops. But remember, if it's a daily chart, you may not get filled because of a gap. We can use a lower time frame. And when you use a lower time frame, it's quite simple. And the time frame you're going to use is going to depend on your schedule and how often you can actually check the charts. For example, this is a 4-hour chart. You're going to notice two price points. 110.75, that's the price in the afternoon where price closes above the trend line. Buy stop orders placed, filled the next day. That's the last candle of that day. $116.64, that's the next day. And this is the price close 4 hours after market opens. And you can use a market order to get in there. And you can also use the hourly chart or the 30-minute chart to trade the break of the daily trend line. When we consider stop losses, there's quite a few ways you can manage those. You can use the low of the entry candle, or you can look 1 to 3 bars back, the low of that one. The average true range method, the ATR, that's a tried and true technique as well. And there's a link above for how to use the ATR. The key overall, though, is don't hold the losers. Okay, we're trading in the direction of a longer term trend, so we expect upon a breakout that price will continue in that direction. And if it doesn't, we could be looking at a deeper pullback. So let's just get out. Now, price targets, just like stop losses, they're a so many different ways to take profits with any trading strategy you use. Some will just use a multiples of risk, right? There's more advanced strategies such as a trailing stop. You can also use the way we enter as an exit. How do we do that? So here the trend line's drawn from the extreme low to new highs. When price breaks to the downside through the trend line, we either exit immediately or we wait until the close. If new highs continue to be made, just redraw the line. We want to take into account that new pricing information. The sell setup, no surprise, we're just going to reverse what we did for buys. Is price under the 200 EMA? Then we're going to sell a break of the trend line. You want to determine your stop loss placement, your profit taking method. And here on this chart, the last 30 minutes of this stock chart gave you your sell entry. And within that 30 minutes, that trade is up $2 per share. So where's your stop? Well, as we talked about earlier, there's a few possibilities. And with this particular chart, given the size of that trigger candlestick, above highs may be a good place to consider, because if price does break higher, it's going to trigger a trend direction of long because it's going to break the 200 EMA. So when do we want to draw new trend lines? To be consistent, we need a rules-based approach to trading. So with this strategy, we need a rule that determines which lows and highs we should be using. Referring to the last chart, you can see previous trend lines that triggered. Well, there's the rule. Let's look at another example here. And while this may look a little bit confusing, it's just really simple once you get the hang of it. I want you to notice that price is above the 200 EMA, so we're only looking to buy when price breaks to the upside over the trend line. So the dashed lines, they're the original lines that were connecting highs and lows. The solid lines are the copied lines or the cloned ones, and that's the one that really matters. We buy the breaks of the trend lines moving down to the left, and we sell our positions when price breaks the trend lines that are heading up to the right. And once price breaks through the trend line and closes, we have to consider drawing a new line. So each buying opportunity on this chart actually gave some profits. The last trade would have given you about $17 profit per share. That gap down would have had you exiting at the market open. So to wrapping this up, I think the strategy, the biggest thing is practice drawing your trend lines. You can use the method I talked about, or you can just use the traditional way. It's up to you. But regardless of which one you're using, being consistent is the key. Can we improve on this strategy? Well, we could add more complexity to it if you want to. But the question is it going to add to your bottom line? Okay, that's important. One idea, though, that's worthy of consideration is to wait for the second period, the day, the week, the hour, whatever your chart time frame is, to close before confirming the break of the trend line, because this will allow that market to go through its normal ebb and flow without whipsawing you back and forth. Okay, just remember to redraw to the new price points. I'll say this, that I prefer this strategy on daily and weekly charts. I find the lower time frames give too many triggers, even using the trend direction filter. But that said, as a day trading strategy, it does have a lot of merit, as you saw in that one example. The key will be to cut your losses quickly. So that's it. I want you to give it a shot. Do some testing. Let me know what you think of it. If you have any questions, put them in the comments below. Make sure you hit like, subscribe, and we'll see you at the next video.